it's not necessarily the only scenario that could happen. And that's why we mentioned in the actual tweet itself, we mentioned that like all possible futures, they develop through a series of twists and turns. The probability, like an asteroid hitting Earth, changes with every observation you make. And we adjust the trajectory on each subsequent observation. The good thing about this trade was that the observation kept getting better and better and better and better. A lot of the times the observation doesn't get better. In the short term, it gets worse, and we let the price go, and we have to pick up the pieces from new macro trade levels. But this one got better every time we observed it. The probability of the asteroid hitting Earth is getting higher and higher and higher and higher. We know we're going to give a big impact. And eventually it gets to the point that we then tweeted out a second message on the 30th of May, which obviously this one was the 29th of May, this is the 30th of May. We sent out a second message at 4 o'clock saying oil was still $2,000 per contract too cheap. You couldn't make it up. But because it's Friday, the smart money will want to keep all the day trader longs and then bust them as often as possible into the close. And obviously day trader longs, they're going to have to close out their positions at the end of day because they're day traders. And as I said here, day traders obviously are not going to hold their long exposure over the weekend, one would imagine, because otherwise they're not day traders then, they're swing traders. So there's going to be a lot of sellers at the closing bell, and sure enough, those sellers potentially gave away over $1,000 on the reopen. And we've just exploded oil price. So there was the original tweet there. There's the original tweet there. And when we take off the original tweet, it'd actually be quite useful to be able to put that original tweet right into where exactly the price was. That'd be quite fun, wouldn't it? So you can kind of get a sense of where would this line have started? That was it there, wasn't it, down there? So we could stretch that out a little bit. You get the basic idea, don't you? So it's something like that. So this trade goes into that tweet, and I know we're not quite exactly on it. If we go to the prices, you'll see that the high is way up here, which is this price here. But I'd have to stretch this out a lot more than I've done to get it to actually sit properly on the trade itself. But anyway, oopsies. But you get the basic idea. We went into the box that we were talking about. We said it was $2,000 higher at 61s. It's just traded past 63 here. And this has been a spectacular trade outcome. Beautiful, beautiful, beautiful trade. Well called in advance as well. Welcome in as well, by the way, guys. Bonds have been great sell-side business. And this was another one we talked about in length yesterday, on Friday, actually. We talked about this one in length on Friday, suggesting that the 210 steepener was probably going to have to keep going, which meant that the bond testing top edges didn't make any real sense. And yet we know it does make sense, because that's what we call the Grail trade experience. And when we know that the sell at the top edge does make sense, it's amazing how trading just becomes about patience, about confidence. That idea of sticking with the plan. The idea that we know that this is going to drop, and we don't know when it's going to drop, but we know it's going to drop. You don't get a steepener coming into bonds as much as this at top edges without the market dropping. So we know it's going to drop, but the challenge we've always got, like everything else, is we've got to have the patience to let it happen. And if we have the patience to let it happen, we went 16.5s to 15s, $1,500 from Friday to this morning's bottom edge. 115 evens, obviously big wholesale price level to walk away from. And, we never got a turn. I didn't get a buy trade reversal out of it. The turn on the 10s pretty much coincided with the turn in bond prices, so we never got a retest. And from that point onwards, yeah, I'd like to be buying if we could get a dip buy opportunity, but I would need to see a bit better discount than this. I mean, it looks pretty rubbish. But certainly dip buying just now would make sense. But you could probably argue that it's about fair value at the moment, and therefore just not a trade I'm interested in. we'll get through today's news. Not that there's been huge amounts, but for a Monday, it's been a wee bit more busier than normal, as we know from the calendar. Not much in terms of coming in from the weekend in terms of data, but let's see what we've got in terms of the London session. We can see as we go in, this is June the 2nd, of course, it's the beginning of the new month. And June the 2nd, we started off with not very much, to be honest. Chinese bank holiday, so nothing much out of China this morning. GDP numbers coming in from the Swiss, better than expected at 0.5%. You might say totally irrelevant, but not really. Any developed nation GDP number is going to be relevant to the rest of Europe, for example. So if Swiss are doing okay on their GDP, you'd imagine that might extend across Europe. Anyway, let's move on to the PMIs this morning, and they're all manufacturing PMIs. And we know that manufacturing PMIs have been solidly below the 50 line for some time. Most important, of course, being the German manufacturing PMI. And yet again, here we go. Straight in with a 48.3. Massively missing forecast of 48.8. Offset slightly by the French GDP PMI's numbers coming in at 49.8, 49.5 forecast and prior, giving us a Eurozone final number actually in line with expectations at 49.4. You can see obviously that we did have one number that actually went way above the forecast, and that was the Spanish manufacturing PMIs. Not the biggest economy in Europe, but certainly a reasonably sized economy, and to suddenly go into positive territory seems obviously quite a significant pop on the upside. Moving through some of the other numbers this morning, you can see that the British London session, we got the manufacturing PMI out of London, and obviously the manufacturing PMIs out of London are usually pretty crap. On this occasion, they are still pretty crap, but they're not quite as crap as they normally are. 46.4 against a 45.1, so still crap, but better version of the crap numbers for the London session. 46.4. Money supply coming in at 0, big fat 0. Mortgage approvals down from 64 to 60,000. Net lending also significantly down from 14.1 billion to just 0.8. Forecast was for a drop, but that's quite a sizable drop. And remember, if mortgage approvals and lending start to drop off, then money's not turning in the system very often. If money's not turning in the system very often, people not taking loans, then fees go down, bank earnings go down, mortgages dropping, then bank fees go down, etc., etc. So these are all things that start to slow the economy gradually, step by step, and we'll see how it develops out. Moving into the afternoon session. And you can see that US manufacturing PMI is expected to see a slight increase, 49.3, 48.7. It isn't until 3 o'clock, of course. Prior to that, we've got the smaller but still reasonable manufacturing PMI, 52.3 in line with prior. ISM manufacturing prices expected to uptick a little bit, 69.8 to 70.2. Construction spending up a little bit as well, 0.4%. Couple of Fed speakers this afternoon, as well as the Powell's comments. 6 o'clock tonight, and that takes us to a closing bell, and plenty to keep ourselves interested in. Remember, if you forget this little 245 release, sometimes it would be quite costly because a lot of people forget about it because it's at that odd time. Just don't be the person that forgets about it. 245 final manufacturing PMI is not the most important, but it can still cause a little spike in price if it's a big miss or a big beat. Then it can still cause a little spike in price on the anticipation that it's maybe going to have an impact on the ISM as well, which is far more followed, of course. So don't miss out on the fact that there's a data release today at 245. Don't be the guy that's in a long position getting spiked out short or whatever, and just recognise that it could have an impact. Anyway, it is expected to post a slightly better number. Manufacturing PMIs as better numbers we know is going to be, you'd imagine, relatively bullish oil. Yeah, bullish oil. So UK numbers, bullish oil. Eurozone numbers in line with expectations, so no change on oil, but bullish oil here. GDP numbers here, bullish oil. So you can see that these are bullish oil numbers, manufacturing PMIs. So a miss on these ones because oil's been very ripping higher today, $3,000 higher from Friday. Because oil's been ripping higher, if these numbers come in softer, you could imagine that oil's going to be quite an easy top line sell, isn't it? Yeah? Reasonable, Paul? Can be on top of this one. What if it beats expectations? Well, oil's going to keep going up. What if it's in line with expectations? Because oil's already priced in the upside. And in line, you would imagine people will profit take on their oil, and the price will probably start getting a little bit of long liquidations into top edges. Maybe not a net short position, but certainly long liquidations into top edges, yeah? So a miss, sell side oil, a strong beat, buy dips on oil, because you don't want to buy because it's already high. So you want to buy dips on oil, and an inline, start liquidating some long oil positions into the number itself, out of the number. All right, guys, I'm going to grab some lunch and then we will get started. Welcome in, guys. Welcome in. It's Monday, the 2nd of June. We've just had a pullback add-in on our NASDAQ S&P, and we've been talking about this add-in trade opportunity this morning. We're going to be working on this on Thursday to give you the exact price about where to take your shot, and that was it. We had an idea that it was going to be down here, but it certainly ran into that beautiful bit of liquidity. Life is good. Interestingly enough, we called this trade out this morning, and it's still buy side. So well done anybody that was still looking at this. But this morning when I came in, we were talking about this trade here. At the time we were talking about it, we were getting these kind of pins here, which says that we should be aiming for this liquidity here. We got that liquidity. We took target price profits. We've had a pullback here, managed to make some nice money. We've had a spring pullback here. We haven't quite hit target price. Target price, of course, is this little fella here. We haven't quite hit that guy yet, but my goodness, have we had a good morning trading pullbacks on the S&P today. Sell side pullbacks did well, made some nice money. Buy side pullbacks did well, made some nice money. This was the only one that didn't quite make it anywhere near the prior, but the prior was miles away. Buy side pullback made some nice money. This was the first trade of the day for us on a pullback trade after a break of structure. Break of structure, guys, unbelievable. It's something as simple as break of structure, a very, very obvious element to the Wyckoff trading arsenal. And Wyckoff, probably one of the earliest traders to talk about this concept of break of structure, certainly one of the earliest traders to put it in print about the idea of breaking market structure and then trading that pullback type narrative, everybody else copying, of course, that Wyckoff process. So we've just hit target price. Well done. So there it is. There's the target price again. Another target taken out. Another target winner right there. So that was good. 97's traded. Bottom edge of 92. So it's only 5 points, but we'll take 5 points any day of the week, won't we? $250. Damn tootin' right we will. Anyhow, lunch calls. I don't know what it is. I've got a funny feeling it might well be that very famous Scottish dish, the chicken jalfrezi. So I think that'll be on the lunch menu today.